Pramod Gubbi, Managing Director and Head of Institutional Equities at Ambit Capital, joins us on the show. Good morning, Pramod. This is Darshan here. Joining me on the show is Navneet. We are heading into earnings season. What's the expectation this time around?
Yeah, I think we saw the beginning of a recovery in the earnings season over the last couple of quarters. I think that should continue, particularly in terms of top line growth. I think given we're seeing the data points coming from the macroeconomies, as far as growth is concerned, I think much of it should get reflected in top line growth. Pretty steady for companies and on a recovery path. Where the earnings euphoria sort of gets offset is the sort of input cost pressure that we're seeing in some sectors, particularly those sectors which don't seem to have much of a pricing power to pass it on. So a lot of the top line growth may not flow down into the earnings growth, particularly given expectations. I think this was 1 year where people were expecting mid-teens to almost close to 20% earnings growth at the index level. The sort of rise in commodities and the input cost pressures might see that having to be downgraded somewhere between 10 and 15%, guess closer to 10%. So yes, we are on the recovery path after almost 4 years of mid-single digit growth. We will see more positive earnings growth, but may not be as high as what one would have expected.
Okay, Pramod, especially on the earnings cut, there's a specific question, because what happened is that what we've seen as far as the consensus Bloomberg estimate is concerned is that from the start of the year till now, till the time the results start coming in, EPS estimates across brokerages on an average have been cut by close to 2%. Have you at Ambit from the start of the year cut your EPS estimates because of the performance that's come in? And if yes, by how much?
I mean, we were a bit circumspect. In fact, our estimates were lower than consensus to start with. But having said that, we've also had to adjust downwards marginally. So, given that the commodity inflation has been quite relentless, and we've seen some of the companies not being able to pass on those prices. So to that extent, we've also had to cut relatively less than the consensus, but yes, the direction is downwards.
How much? Can you identify how much EPS cuts have you done from the start of the year? And which are the sectors which led to this cut?
I think, like I said, most sectors which don't have the brand, the pricing power to pass on in these input costs through to consumers. Particularly around commodity sectors or trading sectors is where we've seen the hit. I think some of the building materials as well, particularly which use copper and so on as input costs. Again, we've seen significant cuts there. Consumer is relatively okay. We're seeing that some of the rural exposed consumer companies are now seeing enough demand so that they can see enough bargaining power to push through price increases and sort of offset the input cost inflation. So there perhaps we're seeing less than what we're seeing in other sectors. But I would say close to about 1% at the index level is what we have seen in terms of earnings downgrades.
Well, Tata Motors, that's bounced back. Remember, the stock touched fresh lows in yesterday's session after some commentary came in on Brexit that could have impacted the profitability, that could impact rather going ahead the profitability of the JLR, that's the European operations of the company. So keep an eye on that one. And the oil marketing companies, despite of rupee depreciating and reaching the mark of 69, we've seen the oil marketing companies doing well in today's session. Hi, Pramod. Good morning to you. Well, halfway through this calendar year, trade war concerns continue. Volatility in the global market also persists. Tell us, what are you advising your clients to do?
Yeah, I mean, it's we're still cautious. We have been cautious and continue to remain so. At the broader market level, certainly the number of potential sources of uncertainty have only increased, both globally as well as locally. I think globally you talked about the trade wars, but there's also the continued tightening by the central banks, particularly the Fed, that's only increasing month on month, unless and until the Fed takes a view that the economy is clearly weakening or inflation is not a threat. they're unlikely to reverse that. So that tightening of liquidity impact on emerging markets will always remain a continued risk, including that for India. And locally as well, I think the political situation will heat up closer to the end of this year with the state elections coming up, and that will also cause further reasons for uncertainty, and volatility is here to stay. And add to it the fact that some of the macroeconomic indicators have begun to show causes of concern, particularly around inflation. We talked about current account deficit, again a reflection of the healthy state of the demand in the economy, but unfortunately much of the demand is being met by imports, which is creating its own pressure on the currency as well. And finally, the fiscal deficit situation, given the sort of MSP increases we've had, I think that's a sign of things to come in terms of how the government is going to extend its spending program, particularly in the rural economy. It'll have its own bearing on the fiscal deficit. So several reasons to worry about, and hence, our sense is at the market level, best to be cautiously positioned. Look at areas which have sustainable earnings growth drivers and remain focused on that. Having said that, I think for the bottom-up investor who can take a relatively longer-term view, the sort of correction that we've seen in small and mid caps, there are pockets where we reckon some of the price action is being overdone and worth getting exposure to some of these good franchises with a relatively long-term view.
Pramod, but do you expect the selling pressure in the broader markets to continue? Because if I look at Nifty on year-to-date basis, that's just about flat or giving you returns of nearly 2 to 3%. So in the second half of the year, we've already seen a lot of correction for the mid-cap and the small-cap indices. Will this pressure continue in the second half also?
Hard to predict. I think a lot of the selling has come from two aspects. One is, of course, we saw the regulatory changes that the SEBI put through for funds, and funds which had to adjust their portfolios accordingly had to exit some of their small and mid caps. In any case, the small and mid cap space was looking a bit overheated given the sort of liquidity. Now that liquidity is tightening a bit, you would expect this sort of correction. And it all depends on how liquidity pans out for the rest of the year as well. I think if at all, you would expect that to tighten further given the sort of pressure on the rupee. If the RBI were to intervene, the liquidity will have to take a bit of a backseat, which would put more pressure on small and mid cap space. The second reason is more about funds themselves taking a more defensive positioning, parking themselves in more liquid large caps in case there is sort of further pressure ahead in the year, given the sort of uncertainties I talked about. So given that, it's likely that we may not see any further or rather a pickup in the small mid cap space. Liquidity is one thing key to watch out for, and given where it's headed, we reckon small and mid caps will be under pressure.
Okay, Pramod, we'll leave it at that. Thanks so much for joining us on the show and giving us your perspective.